What's going on, everyone? I'm here with Jake Kallgren from X5 Homeloans, and today we're going to talk about something that I think a lot of people kind of misunderstand or don't have a great grasp of to begin with. And it seems like it's a little bit behind the curtain, and that is, how does a lender determine how much you're pre-approved for? Because we know it's not just credit score. So, like, what goes into that process? What are some factors that people don't know about?
Yeah, that's a good question. So the first thing that you have to consider as a lender is what loan program is the person going through, because each of the loan programs has an entire book of underwriting guidelines, and that dictates how an originator needs to hit you for liabilities like different payments that you have on your credit report, or liabilities like child support, things like that.
Gotcha.
And how we can calculate your income. So whether you get paid hourly, commission, self-employed, all these different factors that apply to different people, each loan program is going to handle that a little bit differently. What unlocks the program is actually your credit score. So for example, FHA can go down to a 580 credit score, but conventional won't go that low. So if your credit score is only a 580, or in that range, you're only going to have FHA as an option, so you're only going to be able to look at the FHA guidelines.
Gotcha.
Let's say you have an 800 credit score and you have 4 different loan programs that are available. Each one of them is going to be a little bit different in how it calculates your income and your liabilities. But generally speaking, if you have good credit, you should be able to go to about 50% of your what we call your debt to income ratio. So simply speaking, that would be your gross income per month, so to speak. Let's say you made $10,000 per month with your households. That could be you and your wife, for example. And with that, very simply, if you had no debt whatsoever, no monthly payments reporting, you could afford a monthly mortgage payment of $5,000 a month.
Okay, so for gross income, because we went over a lot of terms there, for gross income,
Yeah.
that means before taxes, right?
Before taxes,
Okay,
yep.
Gotcha. So gross income's before taxes. And when we're talking about different loan programs, that's VA, FHA, conventional loans, USDA loans, that sort of thing.
Yep.
And each one of those has their own separate requirements.
Yeah, and as a loan originator, what we're doing, and in underwriting, what they're doing is they're trying to take your gross income, your before tax income. They're transferring that into something that we use in mortgage lending, which is called qualifying income. And the qualifying income is what we're talking about. That's what we're going to use in that debt to income ratio. So I just want to clarify, because if you had 150K gross income on your W-2, that doesn't mean that would be what you would qualify for. It would depend on, well, is that bonus? Is that commission? Is that base pay? Is that a shift differential? There's a million different types of pay that you can get. What our job is to do is to figure out what can be used moving forward, turn that into qualifying income, and then apply that to your debt to income ratio, which is going to consider, all of your liabilities plus the liability of the prospective property that you're buying.
Okay. So for credit score, for example, just to kind of loop back around to that, because I know a lot of people get hung up on thinking about their credit score and how that's going to impact it. Correct me if I'm wrong on this, but so your credit score is going to unlock what type of loan program you're going to have available to you. And then up to a certain extent, your credit score is going to determine how low your interest rate is, which can affect what your monthly payment looks like and how much you're qualified for. Right, so far on that?
Yeah, that's all hitting the nail on the head. And then also it can play into your price range. So if you have really great credit, that's when you're going to unlock that 50% max debt to income ratio. If you have okay credit, the lender may say, well, let's only let you go up to 43%. So that could also restrict your price range. So that can be a good solution too for people who maybe aren't shopping, like they can't afford necessarily the price range they want to be in. If they improve their credit, the lender may find them to be more credit worthy, allow them to borrow more money because you're looked at as a better credit risk.
Gotcha. Okay, so credit score definitely affects it. Now here's a question I have for you, and it's completely okay if you don't know this off the top of your head because I'm just hitting it with you. Is there any real value in striving for like an 850 credit score, for example, on your end of things for what it looks like with these different mortgage programs?
No. I mean, 850, no. Depending on the lender that you're working with, this is an area where it's like another kind of behind the curtains, right? So like a lender could make their criteria only available to those with an 850 credit score. So a lot of advertisements you're going to see for financing, or if you Google something online, that's going to be based off of something that's probably unattainable, like an 850. In the wholesale channel, in real life, what we see is if you're over a 730 on your credit score, there's not going to be a major difference between a rate at a lender between a 730 and an 850. You're in a tier one, you have great credit. There's not going to be much of an adjustment. Now, maybe for like certain, top tier programs or some special something like that, they might target more towards higher credit. But generally speaking, no. I would say the people who really obsess getting from like a 730 to an 850, I kind of not laugh, but I'm just sort of like, oh, it doesn't really matter.
Gotcha. So if you had someone, for example, who had like a 735, let's say, just using random numbers here for argument's sake, but at that point it was probably more important to focus on their debt to income ratio. So paying off debts, maybe seeing if they can improve their income a little bit in order to get them qualified for more.
Yeah, for example, let's say there was an adjustment. I mean, it would be less than 1/8% on the rate, and you're going to unlock the full debt to income, cap at that point. So it's not going to, from a pricing perspective, from a preference perspective, higher credit certainly could be beneficial. But from an affordability perspective, if you've got over a 700, you're probably going to unlock all the different programs that are available to you. And so, yeah.
Okay, easy enough. Now let me hit you with one last thing. This might be an interesting one. I'll see what you come up with. But what are some weird things that you see for liabilities for debts that people don't think of when they start the process? Like any of the kind of strange ones you've seen. I know one of them. We've dealt with this in the past. Is if someone's like co-signed for a property for like a family member or something like that, it can make things a little bit difficult, and that's kind of another part of the process that you have to go down. But any other weird ones?
Yeah, co-signed loans. Well, some things that oftentimes are kind of overlooked or not noticed is like authorized user accounts. So those will report on your credit, and if the lender or the loan originator doesn't recognize that that's that type of account, those can all be excluded. You're not required to make those payments. So sometimes those can sneak through. And the wildest one I had is I had a husband who actually owed his wife child support, which I didn't know was possible to happen, but it is actually.
Oh, so it was a married couple that still had.
It was a married couple, yeah, and it came up like right before their closing, and they didn't really even understand what they had done necessarily. But unfortunately, we did the final review for their closing, and on the guy's pay stub, it actually had a line item for child support. And lo and behold, they applied for some sort of assistance at some point and required, even though they had never been divorced, him to pay child support. So we actually saved that loan by actually like pausing it, redoing it, adding the wife to the loan, ironically, then using it as income for her, because she didn't pay taxes on it. We were actually able to gross it up. So it was more income for her than it was a liability for him. None of it made sense. No, it was all in the same household anyways, but
it's a unique one.
That's an important thing, and the reason why the debt to income ratio is important to know about and have this done right is if let's say your cap is 49.9999%, I can sell that to any lender on the street. 50.0001, your loan gets declined. Right? So like it's very, very, very specific about where those caps are, how that income is calculated. It has to be done correctly because that's what actually gets your loan to go through.
I feel like we're kind of coming back around full circle to how these conversations usually end, which is if you're thinking about buying, if this is a process and a road that you're thinking about going down, talking and going through the process with a lender sooner rather than later and getting a detailed look at all this is super important so that if there's any bumps, if there's any strange things, that doesn't mean it's going to prevent you from being able to buy, but finding out about them sooner, way before it's actually time to start looking at homes is really critical.
Yeah, and it's kind of a cliche thing, like a lot of people say that, or it's like that's talked about, but like in a real life example I can give is I actually was working with somebody recently who is extremely well off. They make well over $500,000 a year verified, on their tax returns. They had no problem at all getting a loan the last time. They didn't think they were going to have a problem at all. They waited right up until the last minute. They had a transaction go through on a credit card from Barnes & Noble, an annual renewal fee that they didn't catch. It was on a Bank of America credit card. It went past due. Their credit score dropped almost 100 points the day before they went to go make an offer on an investment property.
No kidding.
Yeah, and these people had actually planned this year to buy 9 different investment properties. The fact that we were able to figure this out, catch it, kind of find the lender that'll work with it. Now, obviously, their interest rate's not going to be as attractive as it could have been, but even something as small as that, until you actually have that credit pulled, go through the pre-approval process and get that pre-approval letter, you really want to do that in order to ensure you're solid for your financing, that everything's been reviewed up front, and that there's not going to be any surprises, because it's a fast-paced business.
Yeah.
And surprises are not fun.
Yeah, 100%. So getting it done as soon as possible, going through that process, speaking to someone like Jake to go through all of that, just to make sure that you're ready to go, that you're not going to have any weird bumps, because there's enough strange things, as we know, that pop up in real estate transactions all the time that can't be accounted for. But this is something that can be, and that we can have everything taken care of and figured out to begin with. If there's any weird circumstances, or even if it's just a normal circumstance, it's easier to go through it at the beginning, to have plenty of time to sit down and talk about it, than having it come up when you want to write an offer in an hour or something like that.
Yeah, and the only other thing I'd say on that note is, a lot of times people are sensitive to the initial credit pull. It is a hard inquiry. Oftentimes that we can do soft, but for the most part, it's going to be a hard inquiry. People are worried. That's usually 1 to 5 points on your credit. And I would say about 3 out of 5 times when I pull somebody's credit report, not only can we get them pre-approved, but also we have a credit simulator, and we run that on each of our files. So if I pull your credit and your score is a 680, one of the things I'm going to teach you about with your pre-approval is how can we take that 680 and get it up to a 730, especially if that's blocking you from a conventional loan program. We're going to have a plan in place to make it so that you can get to that loan, because it's a much more attractive type of financing, for most sellers.
Yeah,
if
100%.
nothing else, gives you more options to shop with.
Absolutely, more options is better. So
yeah,
awesome. I think we've pretty much covered this one in a great amount of detail. Thank you for sitting down with me and going over it, and we'll see you guys on the next one. I'm going to pop Jake's contact info up here. If you need to get in touch with him, if you're thinking about buying, all his contact info will be somewhere here on the screen, and we'll see you guys on the next one. Thanks so much, Jake.
Thanks.